Good afternoon, everybody. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. We are back at it again. We have a great episode today. We had a great day in the market. Lots of stuff to cover. Really happy. If you guys listened to our last episode, the prayers worked. Things ended up in our favor here with interest rates from Jerome Powell at Jackson Hole this week. So we will talk about that. And guys, stocks are doing good. All right, interest rates are probably going to drop, which we talked about. If that happens, remember, all that cash that's on the sidelines is waiting for interest rates to drop. So I mean, if you're not excited, you should be excited. Okay, this is great news for anybody who has a 401k or anybody who has individual stocks, depending on the stocks. But in general, stocks will benefit. Equities is the term. Equities will benefit significantly from the drop in interest rates. Just like today, all it was news that they were thinking about dropping them, and we gained 1.5%. That's pretty impressive. Pretty good news for us. Okay. We're not doing a term of the day. We're going to do a quote of the day because I got pumped up. We're teaching a course at a local church here. It's kind of like the Dave Ramsey course, but it's like the sequel to it, right? So Dave helps you get out of the hole, and then me and Brandon, we're helping you build the mountain, right? Building the mountain. Dave helps you get out of the hole. And someone was asking me about what my favorite books are. Like, what investment books do you like? What have you read in the past? And really, I haven't really read a good investment book in probably three years, just because I'm in it now, right? I'm not doing so much learning from other people as I am trying to learn the industry. So like Brandon's trying to get his CFP. I'm currently getting my SEMA. We're really in the weeds of the content, of the actual data and the business itself. So when he asked me that, the person at the class that we were teaching, I was like, oh, that's a really good question. And I've probably read 50 investment books, and I could only really remember like 3 of them. And I was like, oh, well, that one's really good. And I thought about it. I was like, what books would I actually recommend to people? And the first one is One Up on Wall Street by Peter Lynch. That is the number one. And because of that, I thought we should have a Peter Lynch quote today for our quote of the day. And this, based upon how the market did today, this is a perfect quote for you to remember in the back of your head. So Peter Lynch says, "The real key to making money in stocks is not to get scared out of them." I'll read it again. The real key to making money in stocks is not to get scared out of them. Huge. It's honestly, when I read it, I was like, that's beautiful. That is a beautiful, simple, concise way to describe our emotional behavior and reaction towards stocks, towards the stock market in general. People get out when the market's down, and they get in when the market's high because they ride momentum, they ride sentiment. When it's actually the exact opposite, you have to be a contrarian. Warren Buffett says you should not invest until there's blood in the streets, which essentially means when other people are freaking out, that's when you jump. When other people are depressed and sad, that's when you jump. Okay, so the real key to making money in stocks is not to get scared out of them. That means pick great companies, stick the course, stay with it, and remember, it's in the waiting, right? That's where all the real money is. Okay, let's get to the news today. Where are we? Guys, great day in the market. Honestly, I can't stress that enough. We had a great day. Why am I slow? What's wrong with me? There we go. Okay. So, today's news. Stocks surged Friday as investors breathed a huge sign of relief after Federal Reserve Chair Jerome Powell indicated that interest rates could be cut. The Dow Jones Industrial Average jumped 1.9%, or about 850 points, hitting a record close high for the first time since last December. The benchmark S&P 500, that's the one we really like, rose 1.5%, snapping a 5-day losing streak and closing fractionally below a record high of its own, while the tech-heavy NASDAQ Composite added 1.9%. Stocks have been under pressure all week as investors anxiously awaited Powell's speech from the Jackson Hole Economic Policy Symposium, aka just call it Jackson Hole, an annual gathering of central bankers from around the world. Thanks to Friday's rally, the Dow and S&P 500 managed to post weekly gains of 1.5% and 3.3% respectively, rising for the third consecutive week. The Nasdaq finished the week down 0.6% after being on pace for its worst week since May at the start of the day. Powell said this morning that the shifting balance of risks may warrant adjusting our policy stance. While inflation risks persist as tariffs work their way through the economy, the downside risks in the labor market have risen, he said. Powell's confirmation that rate cuts could be coming after the Fed has stood pat through 2025 was a welcome development of market participants, who had been pricing in the likelihood of a policy adjustment starting in September. The news sparked a resurgence in investor appetite for risk and gave a big boost to stocks that are particularly sensitive to interest rates. Shares of the world's largest technology companies, which led the broader market slump over the past week, were higher across the board today. Tesla jumped more than 6%, Alphabet and Amazon both added 3%, Meta Platforms rose about 2%, while the chip giants Nvidia, Broadcom each tacked on more than 1%, so did Apple and Microsoft. Among other noteworthy tech sector movers, Intel shares climbed 5.5% after Donald Trump said the beleaguered chip maker had agreed to sell a 10% stake to the U.S. government. Bitcoin was at 117,000 in late afternoon trading, up from an earlier low of 111,700. Bitcoin traders had been selling ahead of Powell's speech. The digital currency had fallen sharply from the record of around 124,000 just over a week ago, amid concerns that the Fed chair might not indicate rate cuts were imminent. Okay, that's all we need to talk about today. Also the yield on the 10-year Treasury, which I do love, which affects borrowing costs on all sorts of loans, was at 4.26%, down from 4.33 at Thursday's close. Okay, I did want to go back to this sentence real quick. Let's see. Here you go. So this is regarding Powell's comments at Jackson Hole. The news sparked a resurgence in investor appetite for risk and gave a big boost to stocks that are particularly sensitive to interest rates. If you remember from last week, we talked about the amount of money that's sitting in cash or cash-like instruments, and it's $7 trillion. Okay, it's there waiting. Okay, it's like the kid on the basketball team that never gets in the game, but the team is up by 30 points. That kid knows he's getting in, and he is ready. He's excited. He's pumped. That's what all this money is. So, yeah, sure, the stocks are at all-time highs. Simply by interest rates lowering and more money coming in, that will increase the S&P 500's number. So my prediction now, which I said many, many times over the last 6 to 12 months, that by the end of this year, we would be between 6,500 and 7,000. I'm going to still say I'm going to say we're at 7,050. That's going to be my prediction. So I thought 7,000 was sort of the ceiling, and now I'm going to bump it up even more, which is a very, very bold prediction. Probably will not be that accurate, but I will be close. That's my assumption. So yeah, we're adding 50 more points to the to our initial ceiling that we put. Guys, it's just there's too much good news happening, and with companies killing earnings. Now, this second half of the year, a lot of this is retail, right? We have holidays and we have more holidays. What do we have? We have Christmas, we have Thanksgiving, we have Halloween. Retail tends to do really, really well in this second half, and especially this last quarter compared to the first half. So I wouldn't be surprised if Walmart, Target, Amazon have a good beat for the rest of the year. And they're big players in the S&P 500. Okay, let's get to the content we wanted to talk about, we also got to talk about Palantir, because Palantir dropped, maybe 20%? If not 20, then close to 20%, just pretty much the last 5 days. And we literally were just talking about Palantir being at all-time highs and how you should probably consider taking profit. Consider it, right? I've had a couple of clients who've made a lot of money in this stock, hundreds of thousands of dollars on tens of thousands investment. They're like, hey, I don't know, should we get out of this? Like, I'm worried. This is why they pay me, because they have no concept of what actually is happening. Hopefully that makes sense to you guys. The people whose money I manage, they conceptually don't understand what's happening with these companies. They view it as a stock. They view it as money that is theirs. That's fine, right? But that's not why. I mean, they wouldn't have hired me, right? There's a reason they hired me, and it's for an exact moment like this. If you're doing your own investments, you absolutely 1,000,000% should have took profits when I told you to. You absolutely should have considered it. Now, what I do and what I've been doing is I know the ins and outs of this company. I can intimately speak to what this company does, who's in charge, and how they're so successful. A 20% drop to me gets me excited. I mean, I'm like, okay, let's put some money into this company. It dropped down 20%. This is our opportunity. It dropped because some guy, I can't even remember his name, but I think he works for Citron. He's an analyst, just an analyst. Okay. Analysts are wrong every day. He was like, hey, this company's worth $40. Okay. There's no way this company's worth more than ChatGPT, and ChatGPT, when it goes public, it's not going to even be worth this much. That thinking is exactly why people miss killers. And when I say killer, we have a term here we like to call them 10-baggers. We try to pick companies that we think within 10 to 15 years, they will tenfold. They will 10x. Maybe not tenfold. Tenfold would be significantly more than 10x, but we believe in 10x companies. Okay? A killer is something that it does more than that. They're tenfold. Killers are tenfold. Okay, you're talking Microsoft, Amazon, Apple, Nvidia, the Home Depot, Waste Management, Costco, Texas Instruments. There's Intel, even way back when Intel. There's a whole bunch of these companies that at one point were valued, or their PE ratio, which is the big thing everybody talks about with Palantir, it was overvalued. Okay, this exact guy that was talking bad about Palantir said the exact same thing about Nvidia in 2016. So we actually have a case study where this guy was negative about the world's most valuable company. And in 2016, he said, nah, PE's too high. This company's not worth what it's trading at. That is technically true in the sense of right now, what is it worth? Okay, but Palantir, Nvidia in 2016, these aren't established players in the game. It's like trying to say, I don't want 2004 LeBron James on my team because he's a second-year player. Like, oh, he hasn't really played in the NBA enough. No, you knew in that very first year that LeBron James was going to be great. You knew it. All you had to do was watch a couple games and see sentiment about everybody else watching him. Now, you're making a huge risk by wanting to. So if you wanted to pay him a max contract to make sure you could lock him in, yeah, that's a huge risk. That is the job, right? That is my job, to find companies that down the road will be worth a significant amount of money. This analyst's job is to tell you right now this company isn't worth what it would cost. But LeBron James in his second year wasn't worth $100 million. But I promise you the other 29 NBA teams would have paid him a premium if they would have been allowed, if there weren't contracts, to join their team. Without a doubt, they all would have done it. Palantir is the exact same way. So yes, is this company right now overvalued? Yeah, it trades at 220 forward PE. It is very expensive. But the reason it's expensive is because there's no other company like this. They have literally had the most recent earnings is, and I mean this sincerely, a top 5 earnings report for any company ever. It might even be number 1. I would need to do a lot of research on that. But the numbers are without a doubt a top 5 ever. Ever. All right. They actually, in software, there's this rule called a rule of 40. And Palantir does so well. And the rule of 40 is like an efficiency measure of how, I don't quite remember what it is. I just was looking at it yesterday. But It's a measurement of how successful a software company is being. And Palantir is so successful, they have to make up a new rule called the Rule of 90. So Palantir is the only company in this Rule of 90 club that they've created. They're trailblazing. They have no debt. Their gross margin, which is how efficiently they make money, is exceptionally high. It's in the 80s. I mean, there are just so many things about this company that is unique and very different. And when we evaluate companies, that's what we look for, right? That is what I'm looking at, and you should too. Okay, so I just wanted to talk about that since Palantir is pretty much that's our company's stock right now. We love it. We've loved it at 16. We loved it at 21, and now we love it in the 150s, 160s. And we bought more. So I'll be honest, for people who had some cash, which we always try to have cash for moments like this, there are going to be major swings with positions like this, always. And you can either get scared and get out, or you can do what Peter Lynch does and says the real money is not getting scared out of them. All right. Real quick, stocks to watch. We got to talk about this. We have now added a new stock to our list, which is United Health. United Health is a very controversial company, right? You got to decide morally if you like it, if you don't like it. I'm a big believer that if I or my clients can make money off of bad people or bad companies, that's okay. That's good stuff. So that's how I'm choosing to look at United Health in this situation. You do your own research, you do your own decision making, but we are adding it to our stocks to watch and as a stock that we are purchasing. We do like it. It's easily the most undervalued company in the S&P 500. It's literally 50% off and also gives a 2.9% dividend. They have $400 billion in cash, no debt. They have a monopoly on the market of healthcare and insurance. It's a pretty safe bet as far as systematic risk goes, which means just market risk, typical risks that come from the stock market. However, there is obviously political risk, right? Like the CEO just got, I probably can't say it, but you know what happened with UNH and the CEO. And if you don't, then go Google it and figure it out. But that's stuff you can't really control. But the fundamentals of the business are still excellent. So we're adding UNH, and I would encourage you to, I guess we'll talk about that. So, and then I was thinking I wanted to finish with, because UNH is a healthcare company. That is not typically what our stocks to watch has. It's usually really aggressive growth companies that we like. And there's AT&T also. They're not aggressive growth, but they did grow 50% this year. So maybe I'm not entirely accurate in that. But healthcare, this will be our first healthcare company. And so I was thinking, what would be the ideal general, like if I had a mannequin and this mannequin was supposed to represent what I thought like a 35-year-old should have in their allocation, in their portfolio. And I came up with something, and I'm not coining it or anything, but if I saw this portfolio, the way it's allocated, I would think this is a pretty balanced portfolio, right? And there are a couple things about designing your portfolio and evaluating stocks or looking at someone else's positions. You have to have risk and reward considered. Okay, both aren't real, which is, I know, a crazy concept, but reward isn't real until after the fact, and risk isn't real because risk is literally the concept of what could happen, right? Just like fear. Like people have fear of public speaking, but it's just they have the fear in and of itself isn't real, right? And just like you have fear of something happening that hasn't happened yet, it's not real. It's the same thing with risk. Risk is the potential of loss. And so when you design a portfolio, you have to be willing to either accept X amount of risk for what reward you want, or you have to accept a low amount of reward for a very low amount of risk. And you have to sort of balance those out, and you have to pick one, right? So you have like the offensive portfolio, which is I want the most amount of reward for so if I want high reward, I have to be willing to accept a certain amount of risk. And if I have low risk tolerance, I have to say, okay, how much risk am I willing to take? And then whatever the most reward I can get for that is fine, right? And you have to come to terms with either one of those positions. And I just thought, if you could design a portfolio for a mannequin, for a general person who's 35, I thought this would be a really great allocation that takes out volatility of owning only a few positions or only one type of sector or individual stock picks. And it kind of lessens the load, right? And I was just thinking about that because we're talking about all these aggressive stocks. And then we're adding United Health. Might make sense to just talk about what an ideal portfolio might look like. And again, this is my opinion. There are immense amount of studies that talk about like a 70-30 portfolio and all of that stuff. The way your relationship with money and risk and reward is yours. So you can't listen to those things, because you will have a problem with it in some way or another. And it's the most important thing you can do is getting something that you can get behind. So this is what I was thinking of. So if you had 100%, right, I would say 60% equities, domestic equities. So to think S&P 500 or individual stocks. Now, if you wanted to do individual stocks, I would do 40% in index, like the S&P 500. And then I would do 20% in individual equities. Okay, so that's 60. And then 15% would be commodities. So now we're talking gold, Bitcoin, oil, whiskey, paintings, art, those types of things. I really like Bitcoin right now as far as my commodity. Gold's fine, and gold is the standard, but Bitcoin is the millennials' gold. Okay, that's just the way it is. Effectively, they're the exact same thing for what it does for the portfolio as far as hedging. So gold and Bitcoin both do not necessarily move the same rate or same direction as the stock market. And that's why you want to have either one of those diversify in your portfolio. Then I would have 10% in international emerging markets. So typically don't like international stocks. However, in this kind of portfolio, I feel like having a well-balanced index where someone else is managing the companies in the emerging markets in the globe would be, or in the world would be good. International markets typically don't move in correlation with the U.S., but they do react to the U.S., if that makes sense. So in the long haul, you might have a 4% difference. Maybe we'll just say 6% on average it gets. However, you might have a year where it does 25% and the stock market might do 18. So that really balances it out well. This year is a really great example. I think international is at 17%, 15 to 17, and currently the U.S. is right around 9%. So that's why we have an international emerging markets. Then we'd have 10%, or then we'd have 5% in dividend and fixed income. This is obviously my least favorite part of the portfolio. However, it does diversify and lower volatility, so it is valuable. I would just put it in an overall bond market, corporate bond, like a Vanguard fixed income fund. And then 10% cash for any opportunities. Okay, 10% cash is critical in almost every portfolio we manage because things happen. Things happen either for an emergency, a liquidation emergency, or Palantir drops 20%, and I want us to get more. Okay, so we'll run over this real quick again. You have 60% in equities, you have 15% in commodities, you have 10% in international emerging markets, 10% cash, and 5% in dividend fixed income. Okay, guys, that is it for today. I'm 10 minutes over my time. What's new? I hope you learned something, and remember, the real money in the stock market is not being able to be scared out of it. Okay, that's it for today, guys. As always, invest early, invest often. We'll see you next week.